Hey everybody, this is Sean Riley with Riley Real Estate and MassHomesale.com coming at you with this week's Q&A Saturday video. This week I'm going to be answering the question of what is a hard money loan. So a hard money loan is a loan on real estate that is based on the hard asset. So it's based on the property. Unlike a regular residential mortgage that most homeowners would have on their house and a lot of investors would have on rental properties, that is loosely based on the value of the property, but it's mostly based on the ability of the borrower to repay the loan. So, for example, for a residential mortgage, you have to have a property that is worth what you're willing to pay for it. If you offer to pay $300,000 for a property and it appraises at $200,000, you're not going to get it. But if you offer to pay $200,000 for a property that turns out to be worth $300,000, but your credit score is under their minimum threshold, you're not going to get the loan either. So that's the big difference between residential mortgage and a hard money loan, is that it's based pretty much exclusively on the property. There are other factors, but again, if you are offering, like in that example, if you are paying $200,000 for a property that's worth, as it is, $300,000, you'll easily get a loan on that. For the hard money loan, they actually base so this is usually something that you're going to use for something that needs a lot of work. So a place that needs a rehab, and generally is not going to, not always, but a lot of times is not going to qualify for a regular mortgage, which, that is part of the problems, again, with a residential mortgage, is that the property has to be in a certain condition in order to be able to get it. So for a hard money loan, what it usually is it's based on what the value of the house is going to be after you do the work to it, and it usually has a component for both the purchase and then also for the construction costs. Sometimes people also say that it's hard because the terms are pretty hard to swallow. There is no set regulations on what lenders charge, but what you usually see is several points at a very high interest rate. So pretty common is, say, 3 points, which a point being 1% of the loan balance as an upfront fee, and then interest rates of 12 or more percent annually. Excuse me. So that's really high. And, it can vary all over the place. Sometimes in a more competitive market, you might get the rates down to 10, maybe even less than that. I have heard of 2 points, but I've also heard of 4 or 5 points, and I've heard interest rates as high as 18% as, not being uncommon. So, there is quite a bit of variability there, but regardless, it's much, much more expensive money or loans to get than what you would get from a bank. So these loans are also made by generally private individuals or institutions that work with investors to invest their money at higher rates for higher returns. They're riskier to some extent, but they can pay off a lot more. There is not the same kind of regulation that you have with banks, because these are considered to be commercial loans, so it's business to business as opposed to being to a homeowner or an individual. A lot of hard money lenders won't even lend to individuals. They might require you to have a company of some sort. Not everyone, but that has become much more common in the last few years after the Dodd-Frank Act came into effect, which increases penalties and procedures needed to make residential loans a lot tougher and a lot more arduous. So people don't want to get into any trouble with that. So if you're doing a commercial business-to-business type loan, you don't have those issues as much. So why would somebody use a hard money loan, given that it's so expensive? The main thing is because a lot of properties that get these kind of loans don't qualify for regular mortgages, and a lot of people who are getting them might not qualify for a regular mortgage. There aren't many avenues in which you can get money to do the construction when you have to do a substantial amount of work to a house. And as I said, except for very few products, there are not ways to get a property to qualify for a residential mortgage if it needs too many things to it. If there's a bad roof, or no heating system, or cracked plumbing, or any sort of things like that, you generally are not going to be able to get a regular mortgage on it. Another thing is, even though typically, again, a lender will want you to have a down payment, the terms are flexible. So if your deal is good enough, sometimes they will have a smaller down payment. Occasionally, you might not even have to bring any money to the closing if your deal is really, really, really good. But that's not that common. So a lot of times, lenders do want to see 25, 30, 35% down, but they don't really care where the money comes from. So if you're getting a mortgage through a bank, the underwriter is going to look at all the financial things, and you basically have to have that money in the bank, or have to account for where every dollar has come from. And there's certain things that they don't like to see, and if they see those, they're not going to let you use that money for part of your down payment and costs. Where a hard money lender, you could go, if you needed a $30,000 down payment, you could take a $30,000 advance on your credit card. They don't care, because they still have first position lien on the property, and the property has to be so valuable that they're going to be able to make all their money back by, if they needed to foreclose on it, even if you never made a payment. So that's another thing where they can be more flexible by not scrutinizing where down payment monies come from. They also generally don't care about your credit or what kind of job you have, that kind of stuff. They like to see experience, because you are going to be doing a construction project, so they prefer people who have done some before. Doesn't mean you can't get something off the bat, but that's where you're probably not going to get as many flexible terms. You're probably going to get the higher rates, the more points, higher down payment requirements, that sort of thing. But there are... So again, this is, like most of these topics, this is quite large and can't get into all the little details, but that sort of outlines the main things. Hard money is usually a lot more fees up front, a much higher interest rate. It's also, didn't talk about this, but it's also generally a very short term. You're not getting 30-year mortgages. You're generally getting something that will be 6 to 12 months. Sometimes you can renew it. I have heard some up to 2 years, but that's pretty much as high as they go, because the idea is that you get in, you get out. The borrower doesn't want to stay there for a very long time. The lender likes to get their money back out there, because they get a lot, a large part of the money comes from the initial upfront points. So even though obviously getting 12, 13, 14, 15% interest on their money is great, it's better to get that after getting another 2, 3, 4 points up front as well. So again, expensive up front, expensive interest rates, very short term. 3 things that are not desirable about the loans. But they can usually close very fast. So when you have a residential mortgage with an underwriter and a bank and all sorts of hang-ups with that, 30 days is sort of the bare minimum. Usually 45 to 60 days is more realistic time frame. Hard money can often close in as little as less than a week sometimes, but 2 weeks is pretty easy for them, for most people. So if you need something to happen fast, it's great. Again, if you don't necessarily have great credit or the right kind of job. So if you're self-employed, banks hate you. Even if you make a lot of money, they just hate you, so it's harder to qualify for a mortgage. Even if you make, like I said, even if you make a lot of money and have great credit and all that stuff. And the main thing is that generally with a regular mortgage, you don't have any access to money to do construction, and most of the properties that are good candidates for hard money are ones that need extensive rehabs, $20, $30, $40, $50, $100,000 worth of work to get them into tip-top shape. So that's where that comes from. So it's good to understand, if you're a seller, that it's very expensive for somebody to fix up your house and be able to resell it. If you're a buyer, it's good to understand that these are going to be really high costs, and you need to factor that in when you're doing your analysis. So anyway, again, like I said, there's a lot more things, a lot more details I can get into. If you want to, if there's anything you want me to elaborate on or have any other questions, obviously you can put them in the comments below. I will answer them as best I can. And if you have any other questions that you want, you can always put them on our Facebook page or Twitter feed, or send an email to massinfo@masshomesale.com. So that's this week's Q&A Saturday video. Thanks a lot for tuning in, and I will see you next week. Bye-bye.